Okay. We talked about our cost of equity. Now we're going to talk about cost of debt. I don't want to talk about it. Do you want to talk about it? All right, fine. We'll talk about it. Well, the weighted average cost of debt. Let's see here. Now we've got a couple different points to keep in mind. This is essentially just outflows and inflows. As I've mentioned over and over, we've got so many ways of using outflows and inflows, inflows and outflows. And just like your credit card bill, or just like calculating how you would determine your, how much you're paying out for debt, well, it's the same thing. We're going to use the weighted average interest rate, and we're going to use our effective annual interest payments divided by debts outstanding. And wouldn't you know it, this is outflows divided by inflows. Oh my gosh, it's crazy. Absolutely crazy. I guess it's it's a little bit different because it's not all of your total inflows. It's just whatever's outstanding still. But same realm of what we talked about. Just want to tie it in for you. All right. Well, the pre-tax cost of debt is also known as the yield to maturity, which we saw in the previous, in the bond yield risk premium, is also known as the market rate of what you're paying on that debt, right? Step two, the after-tax cost of debt is the effective pre-tax cost of debt times 1 minus the tax rate. This is what we saw. So this is what we've seen so far. Well, as I mentioned it, step one is essentially just, okay, if we need to get the pre-tax cost of debt, how do we get that? Well, it's just outflows divided by what you have to pay back, right? It's like if you have $100,000 of student loans outstanding and you paid $1,000 of interest on those student loans this year, then how would you calculate your interest rate, your pre-tax cost of debt? Well, you would do 1,000 divided by 100,000. That gives you 1%. That's your pre-tax cost of debt, and then assuming you could get a tax deduction for your student loans, in the business sense here, then you would just do times 1 minus the tax rate. Again, thinking about it in the realm of a company, so if we are, we're paying out $1,000 in interest, and let's say, we got $100,000 of we have $100,000 of balance left to pay for this machine. Well, 1 divided by 100,000, that's going to get us 1%. So our pre-tax cost of debt is 1%. Say the tax rate is 35%. The 35%, 1 minus tax rate. Do it with me. We've got 1 minus 35 is going to give us 65%. 65. And 1 minus the tax rate is there. So then we do 1% times 65%. All right, put those both, move the decimal point to the left, and that should get us 0.65%. So 0.65% is our cost of debt, right? That is what we are going to do. Awesome. Now, you see here, I mentioned the cost of preferred stock, and why did I do that? Maybe it's because I'm crazy. Maybe that is the reason. Well, let me address that here. That was the cost of debt. Now, cost of preferred stock, pretty similar. Reason it's here is it's pretty similar to cost of debt. It's, but as I mentioned, it's much more similar to debt than it is to common stock, to equity. And preferred stock dividends. So, oh my gosh, what is that? Outflows divided by, shocker, is that inflows? Oh my god, I am just toot my own horn here. Outflows and inflows. Is this outflows and inflows again? Is that a great way to memorize all these formulas I got here for you? It seems to be. And just like I said, the cost of something. What's the cost of something? It's just outflows divided by inflows. Get that down, get that memorized. It'll just help you significantly during the exam. Now, net proceeds of preferred stock. This could be the same thing for debt, right? The inflows, then what are the net inflows? Well, if you have to pay, $1,000 to a company to help you make the loan, or some taxes, whatever it is, if there's fees or other garbage you got to pay, let's say you had $100,000 of inflows and $1,000 of fees, well, it'd just be now $99,000 of net proceeds. So if you pay out just like debt, right? Let's say we have $1,000 of preferred stock outstanding, right? $1,000 of preferred stock. Well, you're gonna, let's say you have a stable preferred stock rate payout of 5%. Just like debt, it's like a fixed income payment. So Well, if we have $1,000 outstanding times 0.05, that's going to be $50 of preferred stock dividends paid out per year. Wonderful. $50 of outflows divided by inflows. Again, let's say, well, yeah, here we'll say that we had $1,000 worth of inflows, but let's say we had $100 worth of fees. So we actually only had $900 of inflows. All right. So then we would just do 50 divided by 900, and that gets us a cost of preferred stock of 5.56%. Here we go. Pretty simple for our cost of preferred stock. There it is. Take it in, enjoy. That's it. All right, let's do an actual example now of our cost of debt. I talked about before, did an example, so you're good. You don't want to do another example, please move along. Actually, one point I wanted to make before doing this. Now, if I've talked about this before, you might be familiar. I am not a fan of our current financial world. I think they make things too complicated for the average individual. In one instance, I'm going to use basis points. There are some questions that talk about this. So, whenever I see on I try not to watch the news, but you ever see on the news or CNBC or any of those shows that they do, which, to be honest, more entertainment than actual news or anything like that, they say, "Oh, it went up by 1,000 points, 1,000 basis points." Now, to me, one, I think that's dumb because it adds an extra step. It makes you learn something additional, which I'll show you how simple that is. And it tries to isolate people by making them think, "Oh, I don't know what a basis point is." Well, you know what it is? It's just a percent. That's all it is. That is all it is. And basis points are just, 1,000 points for a percent. And the reason I bring this up is I have seen it in questions, and I think it's kind of dumb. If any of you out there are in the finance world, I mean, I hope you at least see what I mean. It definitely alienates those who are not as familiar. So instead of saying, "Oh, the market's up by 1%," which I think anyone could understand, right? Up by 1%, it's pretty straightforward. Say, "Oh, it's up by 1,000 basis points." Well, no. No. Let's not say that. Let's just say it went up by 1%. So, right, that's just the conversion. So, for example, 1 basis point is 1/100th of 1% or 0.01%. So 1 basis point equals 0.01%. I would know this for a question. I would also know it just as a little fun fact, piece of trivia. So if you talk in basis points, I ask of you, just for the sake of everyone who doesn't want to deal with that, just talk in percentages. I think let's, and it's an unnecessary step in my mind. If you see there's a reason to use basis points in your career or anything, all power to you. But that's my little rant for the day. But also, obviously, I didn't just do that for my own benefit. I did that for your benefit, so you understand that if you were to see basis points. Now, let's talk about some debt. The weighted average interest rate, this is step one, and then step two is the normal after-tax cost of debt. You might not always have to do the first step one. They might just give you the pre-tax cost of debt. Totally fine. So effective annual interest payments divided by debt outstanding. Let's see what we got here. January 2nd, Boardwalk Investments issued 10 $1,000 bonds outstanding with a coupon rate of 8%. Interest payments are made semi-annually. Company's taxed at a 35% rate. Assume the company made $1,000 payments on July 1st and December 30th. We got semi-annual payments. What is the after-tax cost of debt to be used in the calculation of its WACC? All right, well, here they just straight up give us the pre-tax cost of debt, 8%. Multiply that by 1 minus the tax rate. We did this in our previous example where I kind of just made up some numbers. That gets us to after-tax cost of debt of 5.2%. Now, just keep in mind, this is the depreciation tax shield, right? This is so something was 8%, but because we're saving money on taxes with it, it's really only 5.2% is the cost. Cool. Great. Wonderful. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.